Alright, let's go on topic 4, part 2, fundraising and finance. Of course, now you're wondering, you're not discussing about ordinary shares, preference shares, okay? Okay, of course, we have to do the preliminaries first, inviting investors, what are the things that the investor will need, definitions and things like that, okay? But on topic 4, part 2, we will discuss shares. So that is our focus. Now, with regards to shares, when you are a shareholder, you have certain rights. Okay? When you have it, okay, rights and powers. Okay? Now, the rights mentioned here, okay, we'll go through it. If you are a shareholder, okay, you have the right to what? Appoint or remove a director or auditor. Okay? But it's obvious, majority wins with regards to voting, right? So, if you can only have, let us say, 10 shares out of 1 million shares, even though if he wants to remove a director, you only have 10 out of 1 million shares. Okay? Let us say Miss Wendy has 990 shares, 990,000 shares. Okay? Whatever she mentioned or whatever she wants, okay, most likely it will happen. Okay? We call it the majority win rules. Now, take note that majority rule may be different in one of our discussions. Okay, but generally speaking, whatever the majority wants, they will get. Okay, generally speaking. So, if you are holding a share, you have the power or remove a director or auditor, adopt a constitution if the company opted to have. Okay, again, constitution is not a requirement, but if they do, okay, shareholders may request for it. Alter the company's constitution. Okay, you have the right, okay, as part owner to alter the company constitution. Approve a major transaction if it is especially affecting the financial position of the company and the continuity of the business. Approve an amalgamation or consolidation, merger consolidation of the company. And put the company into liquidation. Oh my God. Okay, so the shareholder will say, I don't want to be with you again. Let's liquidate the company. Okay? It's actually one of the rights of the shareholder. But of course, if you're asking the company to liquidate, there's a process. Okay, I'm just saying that one we will discuss on maybe. I think that's the last portion of the of this unit. Okay, liquidation and insolvency. Another one, right to an equal share in dividends authorized by the board. When you say equal share, if you have 10% share of the total shares outstanding, if the company declared dividend, you will receive 10% of the dividends. If you own 5%, you will receive 5% of the dividends. Okay? What else? The right to an equal share in distribution of surplus assets, especially in liquidation. But in liquidation, there might be a chance that, especially the ordinary shareholders, may not receive much. Okay? Okay, subject to section 51, the rights specified in subsection 1 or on top may be negated, altered, or added to by the constitution of the company. So meaning they can customize the constitution in such a way there may not be so much abuse. Okay, there may not be so much abuse. Now, I just want to be clear, in Companies Act, there is no proper definition of ordinary share and preference share. So which means the Companies Act didn't specifically mention ordinary share and preference share. So take note of that. I really do agree, or let's say I really do understand that, because even back in other countries, they don't really use the term ordinary share and preference share. Okay, so are we clear? So we really do understand that the Companies Act will not be specifying that term, because ordinary share and preference shares are terms used by IFRS, okay, International Financial Reporting Standards. But we have an understanding that there are certain shares that will have most of the time voting rights. Okay, clear? And there are shares that will have preference receiving dividends and surplus assets. Okay? These two terms had been clearly stated in Companies Act. So when you're trying to find the term ordinary share and preference share, most likely you will not see it in Companies Act. Okay? But the description pertaining to ordinary share and preference shares had been stated in Companies Act. So we will discuss it one by one. Okay, subject to constitution of the company, different classes of shares may be issued in a company. Without limiting subsection 1, shares in a company may, take note, be redeemable, confer preferential rights to distribution of capital or income, confer special, limited, or conditional voting rights, or not confer voting rights. So this is the one stated by Companies Act. So the company can issue shares. Okay? They can issue share which is redeemable, which will be having preferential rights over capital or income, or they can give conditional voting rights, or they may not confer that voting rights. If you look into this one is specifically pertaining to preference share. Okay? Preference share can be redeemable. They have preferential rights over income or capital, and they may contain or have voting rights, or they may not have voting rights. So meaning this is the preference share. Okay, no nominal value. A share shall not have a nominal or par value. Okay, noting in subsection 1 prevents the issue by company of a redeemable share. Nothing in subsection 1 prevents the issue of company of a redeemable share. When you say par value, okay, in technical terms, when you say par value, that is the amount or the value of the shares stated in the certificate of shares. Okay, par value. So it says here, for no nominal value, a share shall not have a nominal or par value. Okay. So, but if it is redeemable, it's not actually preventing the company to issue shares, redeemable shares. Now, if you have redeemable shares, most likely you have price. You cannot redeem something without a price, right? So, if you issue redeemable shares, there should be a price or value. Okay? So, that's actually just a clarification on section 1. There are shares that may not be having par value, but redeemable shares must have the redeemable value. Okay? You cannot, again, redeem the shares without the value. Okay. Now, issue of shares, section 43. Subject to this act, the constitution of the company, the board of the company may authorize the issue of shares at any time to any person and in any number it thinks fit. Where the board authorizes the shares or issue of shares which confer rights other than those set in section 37.1 I mentioned a while ago, or which impose any obligation on the holder, the board shall approve terms of issue which set out rights and obligation attached to the shares. Terms of issue approved by the board under subsection 2 shall be consistent with the Constitution, and to the extent they are not so consistent are invalid and of no effect, and deemed to form part of the Constitution and may be amended in accordance with section 33. Now, take note, the board is the one given the power to authorize the issuance of shares. So meaning they will declare shares that they want to offer to the investors. Okay? So they can declare it, they can offer it to any person, and they can give or provide any number of shares, as long as that is up to the authorized shares. Okay? When you apply for company, there will be what we call authorized shares. The authorized shares is the maximum number of shares that you are allowed to issue. Okay? So not more than that. Okay, you cannot issue. Not unless you declare share split. When you have share split, it will double the number of the shares. Okay? But again, only up to the authorized number of shares. Okay, as I mentioned to you, ordinary shares is not specifically defined in Companies Act. As this is the default share, okay, the rights under Section 37, the rights to appoint or dismiss a director, adopt constitution, these rights will be given to the one who holds ordinary shares. Okay, so that is under Section 37. Voting rights. So ordinary share, we call it voting rights. Right? And when you talk about 10% ownership, 50% ownership, it pertains to the number of shares, ordinary shares, held by certain individuals. So if I say 10% ownership by Jürgen, I'm pertaining to ordinary shares because we are only talking about the voting shares. Okay? By default, we are just saying like that. Now, preference shares, these are shares that will have preferential rights over distribution of capital or income. Again, there is no specific title preference shares mentioned in Companies Act. So what I have done is I referred to the International Accounting Standards. Okay, these are types of preference shares. Okay, we have participating, redeemable, and convertible. In Companies Act, they mentioned this also. Redeemable, participating, convertible. But it is not really mentioning about preference share. But in IAS or International Accounting Standards, this will be a definition of participating, redeemable, convertible. Another one is there is such thing as cumulative and non-cumulative. When your preference share is cumulative, okay, any dividends in arrears, so meaning any undeclared dividends will be automatically passed on to the next year if it is cumulative. If it is non-cumulative, if the board of directors had forfeited or didn't declare dividends from the previous year, it's nothing. Okay, so meaning it will be ignored. And company will be what? Sorry, the shareholders will only receive the declared dividend for the current year. So that is cumulative and non-cumulative. So this is not required in our unit, but I thought of sharing it to you because in the future you might be a board of director, one of you, or all of you. I'm not sure, but at least maybe one of you may be a part of the board. And these are types of preference shares. Okay? Okay, next. Section 46 about consideration for issue of shares. Okay, the consideration for which a share is issued may take in any form and may be cash, promissory notes, contracts for future services, real or personal property, or other securities of the company. So which means whatever type of consideration that possibly be given by investors can be classified as consideration. Of course, we most likely will think of cash. Okay, that's automatic. If an investor wants to put an investment, cash. But some can provide property. Okay, so land, maybe they want to contribute land instead of cash. Company can consider that. Okay. Now, of course, consideration should be, shall we say, noted or approved, okay, by someone. And who will be the one who will say, okay, the land will be fine with us. Okay, your machine will be fine with us. Okay, who will decide on it? Board. Okay, the board will determine what are the considerations that they need. Remember, one particular reasons why we are issuing shares is because most likely we want funds or resources, right? So the board may decide on we want to receive cash. Why they want to receive cash? Maybe they want to use cash for expansion or maybe for operational use. Okay. Before the board of the company issues shares, the board shall decide the consideration for which the shares will be issued, resolve that, in its opinion, the consideration for the terms of the issue and fair and reasonable to the company and to all existing shareholders. The directors who vote in favor of resolution required by this subsection shall forthwith sign a certificate. Take note of this. So meaning, those directors who said, okay, our resolution is to receive cash only. Or our resolution is to receive property. Okay? So those directors who are in favor of it, they have to sign a certificate stating the consideration for the issue of the share and stating that, in their opinion, consideration for the issue is fair and reasonable to the company and to all existing shareholders. Okay, so they will have to sign on it. Okay. So it's fine, it's fair, it's reasonable, we will sign. Okay. So which means the directors are now being held accountable on the decision that they made. Whether they want to receive cash or property, land, building, machinery, or maybe bonds, okay, as investment. Alright, preemptive rights. The preemptive rights, as the word says, the shareholders have a right or preemptive, that's why we call it preemptive right, to purchase share before it will be offered to others. Okay, that's a good idea, right? Okay, why is it that the companies have included preemptive rights? It works like this, okay? Just imagine, let's say, then here. Okay, then here we call you then. You ready? Kita. Okay. Let's just imagine, okay, we are all shareholders here. And let us say I'm part of the board. Okay? And then this is what we will do. Okay? I don't want Yankee to be receiving more shares. I want to empower Peter. Okay? So I will only offer the shares that we will issue to Peter. Okay? So what will happen in that situation? What will happen is we are diluting the ownership of Denki. And by empowering Peter. You got it, huh? We will not issue it to Denki, we will issue it to Jürgen also, okay, to Wendy and then Helena. What will happen with Denki? His percentage of ownership will become what? Smaller. Right? So the preemptive rights is giving the chance for the existing owners whether they like to increase their ownership. Okay? It's fair, right? It's fair. Now, the preemptive rights actually giving or offering a reasonable amount, okay, or fair amount. Most likely, they will offer it at a smaller price comparing with others. Okay? That's practice. Okay? So preemptive rights, they give you rights, things like that. But it's not automatic. Okay, I'm just saying. Most likely it will be lower than the market price, but it's not automatic. Okay, so are we clear why we have preemptive rights? Okay. Now, what else? Okay. An offer under subsection 1 shall remain open for acceptance for a reasonable time. So, the company must provide us with reasonable time as a shareholder to acquire the rights. So meaning, you don't want, okay, I really don't like Jürgen because during the annual general meeting is always criticizing what we're doing as a board. So we just give Jürgen 2 days. While Elena always saying yes to us, okay, and always supporting us. I will give her 1 year. Okay, so this is not again fair. Okay, so make sure that the time that you're giving for the shareholders to think of, yeah, I want to exercise my rights, should be reasonable. Okay. The constitution of the company may negate, limit, or modify the requirement of this section. Okay. So meaning, it can be strengthened or can be altered by the constitution if they want. Okay. Okay, section 41 about contracts for issue of shares. Okay, I'm actually trying to cite the specific section here so that when it comes to the final examination, you're familiar with where to find those. Okay, this is one thing that you really need, especially in the final examination, to know where to find the section. Okay? So that's why I'm including the sections here. Contracts for issue of shares, a contract or deed under which company is or may be required to issue shares, whether on the exercise of an option, or on the conversion of securities or otherwise, is unlawful and void unless has authorized the issue of shares under Section 43 or has complied with Section 47. Later we will discuss those. Okay, nothing in subsection 1 applies to a contract or deed which provides that the obligation of the company to issue shares is conditional on the board. Okay. Authorizing the issue of shares under Section 43 and complying with Section 47. Okay, another interesting discussion is distribution. Okay. Now, in distribution, in Section 2, Section 1, where you can find the definition. Okay, in Section 2 of Companies Act, if you're not clear with the definition, you just go through it, you will see the definition of the terms. Distribution in relation to the distribution by a company to a shareholder means, okay, the direct or indirect transfer of money or property other than the company's own shares, okay, to or for the benefit of the shareholder. So, take note of it. It is a direct or indirect transfer of money or property. Of course, not including shares. So what does it mean? Does it mean dividends only? Now that's a good question. In this definition, it's not clear whether the section is the definition is really pertaining to dividends. Okay, because what the law said, if it is money or property given to shareholder by the company, that is what we call distribution. So which means, in this case, the term distribution can include dividends. But distribution may not be limited to dividends only. You got it, huh? Are we clear? Now, why I'm emphasizing on this? Because especially in taxation, if you're studying taxation, they will also discuss this. So anything that the company is providing to the shareholder, whether money or property, is called distribution. But it doesn't automatically mean dividends. Okay? Clear? Okay. The incurring of a debt to or for the benefit of shareholder in relation to shares held by that shareholder, and whether by means of purchase of property, redemption of other acquisitions of shares, a distribution of indebtedness, or by some other means. So you've seen here, it says incurring of a debt or for the benefit of the shareholder. So which means they absorb the loans or liability for the benefit of the shareholder. So again, distribution doesn't only mean dividends, as I clearly stated a while ago. As long as it's benefiting any transfer that we made to the shareholder coming from the company, whatever it means, that will be considered distribution. Okay? Now, this is the definition of dividends under Section 51. A dividend is a distribution other than distribution to which Section 56, okay, or we call it company acquiring own shares, or Section 63, company may give financial assistance. So which means acquiring own shares, giving financial assistance to shareholders can be considered distribution. Okay? The board, the company shall not authorize dividends in respect of some but not all the shares in class, or that is greater value per share in respect of some shares of a class than it is respect to the other class of that class. Unless the amount of dividend in respect of share of that class is in proportion to the amount paid to the company in satisfaction of the liability of the shareholder under the constitution of the company or under the terms of the share. Shareholder may waive his entitlement to receive dividends by notice in writing to the company signed by or on behalf of the shareholder. Okay, so which means the shareholder, if they don't want, I don't know why they don't want. Okay, you don't want to receive dividends. Anyways, in any case, they have to put it or send it, okay, the notice in writing. Now, is it possible for the company to issue or distribute shares, okay, which is what we call an alternate of cash dividends? That is still fine. So, which means the company can, or the board of directors can declare share dividends, okay, or in accounting they call that term bonus issue, okay, bonus issue. Okay, so those particulars are included in section 52. Okay, so I will not go through it. You can refer to the section. Okay, but just to make it short, board of directors can issue or can declare share dividends. Okay, in lieu of the cash or instead of cash. In satisfying the solvency test, first, the company is able to pay its debts as they become due in ordinary course of business. So which means, especially in this situation, where companies are having financial difficulties, this is not, we call ordinary course. Okay? So which means companies may not be able to pay. Okay? The value of the company's assets is greater than the value of its liabilities, including contingent liabilities. Okay, so when you do solvency test, I want you to take note of this because maybe on the next discussion with regards to membership, okay, it may come again. Okay, so solvency test, as long as the company can still pay their outstanding liability or liabilities becoming due, okay, they are able to pay and assets are greater than liability, they can still pass the solvency test. Okay, take note of this. This will be important. Okay. Okay, so company may acquire or redeem its own shares. That will be under section 56. That's obvious. Okay, so the company may, at their decision, may acquire or redeem its own shares. Okay, we call it business term. We call it share buyback. Okay, so it's a share buyback. If it is redeemable, of course, there's a fixed time to redeem the shares. Okay, so that's why I mentioned a while ago redeemable shares. Okay, redeemable preference shares. Now they can decide on when they want to redeem shares if it is not if it is not stating when it is redeemable. Okay, so the company, the board of directors can decide when they will redeem the shares. Okay. Okay, immediately following the acquisition or redemption of shares by a company, the company shall submit a notice in the prescribed form to the registrar of the number and class of shares acquired or redeemed. So they have to inform the registrar. When I say registrar, that is the registrar of companies at IPA. Okay, so that's the term. Does the company has the capacity to borrow money? Yes. Okay, as treated as legal entity, they have the capacity to borrow money. A while ago, we discussed about debenture. Okay. Now, I want to take note of a particular statement here, okay? Debenture can be convertible or non-convertible. Loans can be secured or unsecured, okay? Actually, there is a particular section that we will discuss about secured creditor, okay? So, secured creditor means a person entitled to charge on or over property owned by that company. So, which means if you are a secured creditor, something goes wrong with the company, they want to file for bankruptcy, you are actually secured to have that property, right? So, the unsecured creditors usually will be in the losing end, okay, when liquidation or bankruptcy comes. Secured creditor, you're not allowed to dispose of property because it's under my name, it's for me only, right? Okay, so secured creditor may realize property subject to a charge if entitled to do so, or value the property subject to the charge and claim in the liquidation as unsecured creditor for the balance, if any, or surrender the charge to the liquidator for the general benefit of the creditors and claim in the liquidation as an unsecured creditor for the whole debt. Oh, okay, so they are willing to give up their claim, okay, because they're allowing liquidator, okay, to uh, have the property. They will surrender their right over the property and let the liquidator to pay all the liabilities. In that case, he will be classified as unsecured creditor because he's already given up the right over the property. Okay, I'm skipping some. Okay, so meaning you can go through it. It's for your own reading. Okay, so all right, so that's my discussion for today. Already I know. All right, so that's my discussion for today. Thank you for attending the session.